We're jumping straight into Palantir today. Everyone is watching the price action. But the real story is its massive 137% surge in U.S. commercial revenue driven by real-world AI adoption.
Yeah, it truly is a paradigm shift. I mean, we are looking at an enterprise that for years was perceived entirely as this shadowy government contractor.
Like a total black box.
Exactly.
Yeah.
To most of the market, it was just a black box of defense analytics. But right now, today, in March of 2026, we're witnessing one of the most aggressive and, frankly, successful pivots to commercial enterprise dominance in modern software history.
Okay, let's unpack this. The sheer scale of what happened with their recently dropped Q4 2025 earnings report is nothing short of historic for their growth trajectory.
Oh, absolutely.
We aren't just talking about, a slight beat on expectations or tweaking a guidance model by a few percentage points. We're talking about a fundamental rewriting of their corporate DNA.
Yeah.
For the longest time, the narrative was that their software was too complex.
Too bespoke.
Right, too bespoke and way too expensive for anyone outside of the Pentagon or the CIA to actually use. But the numbers we're looking at today completely shatter that old storyline.
What's fascinating here is the psychological shift in the broader market. As an investor, or even just a casual observer of the tech sector, you have to understand why this shift from government-only contracts to enterprise commercial dominance matters to you right now.
Exactly.
Governments buy software based on geopolitical necessity, right?
Yeah.
Long-term security architecture. And they move slowly. But Fortune 500 companies, they buy software for one reason.
Immediate, measurable return on investment.
Exactly. The fact that commercial enterprises are suddenly adopting these platforms at this staggering rate, it proves the technology isn't just some theoretical defense mechanism anymore. It shows that the promised productivity gains of the AI boom are finally materializing on actual corporate income statements.
I love that distinction. It's like it's the difference between buying an insurance policy and buying an engine, and the proof is officially in the pudding.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you want to keep staying ahead of the curve, make sure you subscribe and hit the like button. Our whole mission here is to simplify this incredibly complex financial data so you can cut through the noise.
All right.
We want you to understand the underlying mechanics of these massive market shifts and honestly make better decisions with your own capital. We do the heavy lifting, digging through the earnings calls and the technical data so you don't have to.
Let's break that down even further, starting with the absolute explosion in their revenue and earnings.
The numbers are just staggering.
Yeah.
And I want to put them into context so it doesn't just sound like we're reading off a spreadsheet. In the fourth quarter of 2025 alone, their revenue hit $1.41 billion.
Which is up 70% year over year.
Right. Think about that for a second. The law of large numbers dictates that as a company gets bigger, its growth percentage naturally slows down. A 70% growth rate for a company already operating at a billion-dollar quarterly scale is practically unheard of in enterprise software. It's like watching a colossal cargo ship suddenly accelerate with the agility of a speedboat.
That's a great way to put it.
And over the full year of 2025, they pulled in $4.48 billion, a 56% increase overall. We're looking at 10 consecutive quarters of accelerating growth. Every single quarter, the snowball is rolling down the hill, getting larger and moving faster.
And that acceleration is largely being driven by the widespread adoption of their artificial intelligence platform, which they call AIP. But what really caught the market off guard, what truly blew the roof off the consensus models, was their forward guidance.
Oh man, the guidance was insane.
It really was. Wall Street builds these very rigid models based on historical precedents. For the full year of 2026, analysts had modeled out around a 43% growth rate. They thought they were being optimistic. Then the company came out and issued revenue guidance of $7.18 to $7.2 billion. They essentially looked at Wall Street and said, no, we are going to grow at 61%.
Beating consensus by 18 percentage points on a multi-billion-dollar base is a structural shock to the market. When a management team steps up to the microphone and confidently projects a 61% growth rate, they're signaling unprecedented visibility into their sales pipeline.
They aren't guessing.
No, not at all. They have the contracts in hand or in late-stage negotiations. And the star of the show, without a doubt, is that U.S. commercial revenue. They expect the U.S. commercial side alone to exceed $3.14 billion in 2026.
That's a growth rate north of 115%. It's phenomenal.
It is. But frankly, it's not just the top-line revenue that's impressive to me. It's how efficiently they are converting that revenue into actual tangible profit. They posted incredibly high 57% operating margins in the fourth quarter.
To put a 57% operating margin into perspective for you, it means for every dollar of revenue they bring in, 57 cents is dropping straight down to operating profit before taxes and interest.
It's huge.
In the software industry, hitting a 30% margin is considered excellent. Hitting 57% is industry-leading elite territory. It reflects the fact that their core platforms are highly scalable. We should probably define those platforms quickly.
Yeah, that's a good idea.
So you have Gotham, which is their legacy defense intelligence software. You have Foundry, which handles corporate data integration. You have AIP, their newer artificial intelligence platform. And you have Apollo, which ensures secure, continuous deployment of all this software.
Right.
Once that software architecture is built and deployed, the marginal cost of adding a new customer is relatively minimal. This operational efficiency is exactly why they're currently on a path to generating an estimated $6 billion in free cash flow by the year 2030, entirely organically, without relying on loading up the balance sheet with debt.
That zero debt reliance is such a crucial point, especially given the macroeconomic turbulence we've seen over the last few years. They are funding their own hypergrowth with cash they're genuinely generating for their operations.
Exactly.
But I want to pivot a bit to how they are actually doing this. Because having great technology is only half the battle. You have to actually convince legacy executives to buy it. We hear the word moat thrown around a lot in finance, but they have built something incredibly distinct.
They absolutely have. Their competitive moat is built on a foundation of extremely high switching costs and proprietary data integration. Most enterprise software is just a tool you use, like a word processor or a basic CRM.
Right.
But when a major logistics company or a sprawling hospital network integrates a system like Foundry or AIP, it doesn't just sit on top of their existing software. It weaves itself into the very fabric of their daily operations. It acts as a central nervous system.
It connects everything.
It connects disparate data silos, supply chain metrics, human resources, real-time weather patterns, things that have never actually spoken to each other before.
Right. And once a company gets used to operating with that level of real-time integrated intelligence, ripping that software out and replacing it with a competitor becomes a logistical nightmare.
Oh, completely.
You don't just uninstall a central nervous system without paralyzing the patient. The switching costs are astronomically high, which leads to incredible customer retention.
Precisely. And the way they are acquiring these customers is genuinely disruptive. Historically, enterprise software sales involves sending an army of slick salespeople in expensive suits to take executives out to fancy dinners, followed by a 6-month integration process.
The classic wine and dine.
Exactly. Instead, they utilize a bootcamp strategy. They send in forward-deployed engineers. They sit down with a potential client, take their messy, unorganized, real-world data, and within a matter of days, sometimes over a single weekend, they build a functional, customized application that solves a specific business problem.
But wait, I have to push back on that a little bit. Sending highly paid, specialized engineers out to individual clients over a weekend sounds incredibly resource-heavy. We've all worked at companies where a basic software upgrade takes 6 months to install and somehow makes everyone's job harder.
Right.
So the idea that they are walking in and building a custom AI app over a single weekend is mind-blowing to anyone who has ever waited 3 weeks for IT to reset a password. How is that bootcamp strategy actually scalable long-term?
It's a great question, and it speaks directly to the power of the platforms themselves. The engineers aren't coding from scratch at these bootcamps. They are utilizing the underlying architecture of AIP and Foundry, which allows for rapid modular deployment.
Oh, I see.
It's like letting someone test drive a hypercar on a racetrack instead of just showing them a glossy brochure. This strategy creates immediate, undeniable aha moments for executives. It drastically shortens the sales cycle from months down to days.
That makes a lot of sense.
Yeah. And once that initial use case is proven, it creates internal network effects. The logistics department sees what the finance department is doing with the software, and suddenly they want a custom module too. Traditional software rivals simply cannot match that velocity of deployment.
And we also have to factor in the foundational advantage of their deep government ties. Yes, the commercial side is exploding, but their roots in the defense sector provide an unmatched layer of credibility regarding security.
Absolutely.
We're talking about extensive foundational relationships like the $10 billion U.S. Army deal.
Yeah.
We can't forget their deep involvement with Project Maven, which is essentially the Pentagon's flagship AI program.
That credibility is a profound competitive advantage. When they walk into a highly regulated commercial enterprise, say a major financial institution or a healthcare provider dealing with highly sensitive patient data, they can say, look, the Pentagon trusts us with national security data and classified intelligence. You can trust us with your supply chain metrics and customer records.
Yeah, that's huge.
That is a trump card regarding data security that competitors like Snowflake or Databricks simply do not hold in the same way.
Exactly. And all of this fundamental business strength, the margins, the bootcamps, the government trust, has translated into overwhelming market momentum. Over the past year, the stock has posted a staggering 144% performance.
Incredible run.
We're currently seeing the price sitting around $135.68. But here's the kicker. Major institutional players are actively readjusting their valuation models based on this new commercial reality. UBS and Citi have recently upgraded their consensus price targets, pushing them into the $180 to $235 range.
Right.
If you do the math on that upper end, it implies up to an 87% upside from where the stock is currently trading. And a lot of this bullish momentum is being fueled by new strategic alliances. Specifically, the newly announced partnership with Rackspace.
The Rackspace partnership is highly strategic because it acts as a force multiplier. Rackspace already possesses the cloud infrastructure and the existing trusted relationships with thousands of enterprise clients.
Right, they have the footprint.
By pairing Rackspace's infrastructure with this advanced AI platform, they are essentially creating a turnkey solution for heavily regulated companies. It's for the enterprises that desperately want the power of advanced analytics, but absolutely do not want the headache of building the underlying architecture from scratch. It provides a significant runway for future commercial growth.
Looking at the flip side, because we promised you the complete picture, not just the highlights, no company is immune to gravity, and we have to talk about the risks.
This raises an important question. How much of this incredible future growth is already priced into the stock today? Because despite the substantial year-over-year gains we just discussed, it's vital to note that the stock is currently trading down 35% from its absolute recent peaks.
Right.
That level of volatility tells us that the market is grappling with valuation.
And this is exactly what Jim Cramer was highlighting recently. He laid out a perspective that really resonated with a lot of institutional watchers. He framed the company as a very long-term play, a generational technology company that you hang on to for years.
Right.
But he also warned that the valuation has gotten way ahead of itself in the short term. The danger here is being priced for absolute perfection. You are paying an extensive premium for that projected 61% growth.
Exactly.
If they hit a speed bump and only deliver 55%, which, let's be honest, is still an incredible growth rate for any normal company year, the market might punish them severely for it.
Yeah.
Growth stocks live and die by the multiple expansion, and when expectations are this high, there is zero margin for error.
Beyond just the raw valuation multiples, there are significant industry and regulatory risks that we need to explore to give you the broader context. There is an increasing wave of regulatory scrutiny globally surrounding artificial intelligence,
Especially in defense.
particularly regarding AI-powered weapons and autonomous defense systems, because a significant portion of their foundational revenue still relies on defense contracts and global military alliances. Any shift in international law or a major regulatory pushback against autonomous military technology could create extensive headwinds for their government business.
For sure.
It could delay contract renewals or shrink the total addressable market in Europe, for instance.
And it's not just the government side that carries regulatory or operational risk. There is what analysts are calling AI comprehension risk in the commercial sector.
This is a huge one.
Right now, there is an immense fear of missing out among corporate executives. Everyone wants to be an AI-driven company because it sounds great on an earnings call, so they're throwing billions of dollars at software platforms.
Yep.
But there is a very real danger that these enterprises are buying complex software suites that their internal teams simply do not fully understand or know how to properly utilize yet. We call it shelfware software you pay for, but never take off the shelf.
That is a critical point. The difference between deploying software and actually integrating it into a daily corporate workflow is vast. If we see a wave of companies realizing they are paying millions of dollars annually for software that their employees aren't actually using efficiently, we could see a sudden, sharp contraction in those commercial renewal rates a year or two down the line.
Here's where it gets really interesting, because the insider signals we are seeing right now are incredibly complex and highly debated. Peter Thiel, who is obviously a foundational figure in the company's history, recently issued a $74 million warning regarding a potential flux in artificial intelligence interest.
Yes.
He's effectively signaling that the current hype cycle might be overheating and that capital might start rotating out of the sector.
It is essential to clarify the nuance of that warning, though, to make sure we understand the specific financial mechanics. Thiel recently dumped $74 million worth of shares in other broader tech and AI index funds. Public filings show no direct immediate sales of his Palantir stock associated with this specific warning. He didn't touch his core holdings.
Right, but when the godfather of your company starts cashing out of the broader AI neighborhood, people naturally start looking at property values across the whole block.
Sure.
Even if he isn't selling his own house, it signals caution.
Exactly. So you have institutional flow sending mixed signals. On one hand, you have major banks upgrading their target prices based on incredible, tangible revenue visibility. On the other hand, you have seasoned Silicon Valley veterans suggesting the broader AI tide might be getting ready to recede a bit. It creates a fascinating tug-of-war for the stock's narrative.
So what does this all mean? How do we synthesize these explosive growth numbers with the very real valuation and macroeconomic risks?
Well, we have to look ahead at the immediate calendar.
The next 30 to 90 days are going to be absolutely crucial for the narrative. The first major milestone to circle on your calendar is the Q1 2026 earnings report, which is expected to drop in mid-May. The market is going to be watching that report hawkishly.
Oh, without a doubt.
The question isn't just whether they had a good quarter. The question is whether they are pacing to actually beat that $7.2 billion full-year guidance they just laid out. They set the bar astronomically high, and now they have to prove they can consistently clear it.
Alongside the earnings, you should be watching closely for new product reveals related to the AIP platform, particularly any developments stemming directly from that new Rackspace partnership.
Right, conference season is coming up.
Exactly. We are heading into a season of major industry conferences. Any tangible proof that this infrastructure partnership is rapidly accelerating deployments in heavily regulated sectors like banking, insurance, or healthcare will be a major positive catalyst. It will prove the commercial pivot is still accelerating.
And we absolutely cannot ignore the macro drivers that are shaping 2026. We are operating in an environment where we expect to see defense budget increases under the current administration, which obviously bolsters their legacy government business.
Right.
We're also watching potential interest rate cuts. High-growth software companies with significant future cash flows tend to benefit disproportionately when the cost of capital comes down because it makes their future earnings more valuable in present-day discount models.
True.
But there is also the wild card of sector rotation. If the broader market decides it's fatigued with AI and wants to rotate capital back into industrials, energy, or commodities, even the best underlying fundamentals might not prevent a short-term drag on the stock price.
If we connect this to the bigger picture, we have to talk about the speculative catalysts that are currently dominating the rumor mill. There are highly unconfirmed but incredibly persistent rumors circulating in Washington regarding the company's potential involvement in a new DOGE government efficiency role.
Oh man, the DOGE rumors.
Yeah. For those unfamiliar, DOGE stands for the Department of Government Efficiency. The idea is that their sophisticated data integration software could be deployed not just for defense intelligence, but to actively audit and streamline the sprawling bureaucratic waste across various civilian federal agencies.
If that were to materialize, it would represent an entirely new, massive revenue vertical within the government sector. Tracking waste across Medicare, the IRS, or the Department of Transportation using AI would be an unprecedented government contract.
Precisely. Additionally, there are strong rumors that the AIP bootcamps are aggressively expanding far deeper into the Fortune 500 than previously disclosed.
Deeper into the legacy stuff.
Yeah, they are allegedly targeting legacy industrial companies,
What?
manufacturing, legacy auto, heavy logistics, sectors that desperately need modernization to maintain their own margins, but historically haven't been viewed as cutting-edge software adopters.
It's an incredibly dynamic situation. The mechanics of what they are doing right now, taking the absolute bleeding edge of defense-grade artificial intelligence and successfully packaging it for the corporate world, is something business schools are going to be studying for a decade.
Which leaves us with a provocative thought to consider as we wrap up our analysis today. We noted earlier that there is a staggering $4.38 billion in remaining deal value purely in their U.S. commercial contracts.
Right.
That is money on the books, waiting to be realized. When you look at that backlog, you have to wonder, is the true compounding network effect of their bootcamp strategy just beginning to ripple through the global economy?
It's a great question.
As these initial Fortune 500 adopters begin to dominate their respective industries using the software to cut costs and boost margins, will their competitors be forced to adopt it just to survive? We may be rapidly approaching a tipping point where their commercial arm entirely eclipses their legendary government defense origins faster than anyone, even their most optimistic advocates, ever predicted.
And that brings us to the lowdown. Whether you view Palantir as an overvalued tech darling, currently priced for an absolute perfection it might struggle to maintain, or you see it as a generational, multi-year compounder, steadily charting its path toward $10 billion in scalable revenue. The momentum they're generating right now is simply impossible to ignore. They have successfully bridged the gap between military intelligence and corporate efficiency. Stay sharp out there, keep questioning the market consensus, trust your own research, and we will see you right back here next time.